Well, hello and welcome to India Decides, the FII View with me, Tanveer Gill. We are back with another guest on the series that puts a spotlight on India, given the global backdrop and the key local event in elections. Dilek Capanoglu is Chief Investment Officer of Global Emerging Markets Equities at Allianz Global Investors. She joins me all the way from London. Dilek, good to have you on the show. Thanks very much for taking out the time to speak with us today. Let me begin by asking you about your India view. Now, is India turning out to be in 2014 what Japan was for the markets in 2013? That is a potential re-rating story with most funds turning overweight on the market in the last 6 months.
Indeed, we have seen a lot of inflows into the Indian equity market, especially year to date. Whereas we have been seeing outflows out of the larger markets, India has been seeing consistent inflows, and especially in the last week of March alone, we have seen $1.2 billion inflow into Indian equities. Now the question is this a re-rating story? Is it something fundamentally changed in India? Or is it just a turn in sentiment by not backed up by fundamentals? I would answer this question twofold. First of all, we have seen some economic stabilization. So we have seen PMIs improve, we have seen some export data improve, but also it is mainly driven by the expectations and the sentiment towards the outcome of the elections. Is India a re-rating story? I would actually caution against that, because we have already a lot of the positive news flow priced in, so there is going to be some room for profit taking.
Well, how are you viewing, as a fund manager, all the aggressive targets being put out by the sell-side analysts on the Indian market? I mean, Goldman Sachs has come out with a target of 7,600, CLSA talks about 8,800. The market at 14-15 times the FI 15 earnings is working with an earnings assumption of anywhere between 15 to 17% for FI 15. How much value do you see in the market then accounting for these assumptions? How much more upside is there really?
As I was saying earlier, I think a lot of the positive expectations have already been priced into the market. And in fact, we have not seen, especially in the cyclical side, we have not seen the impact on the earnings side yet. A lot of the expectation is really built upon a positive outcome of the elections, that we will have a very business-friendly and reform-friendly government, which will push through economic reforms. Hence, I think the targets are fairly aggressive. But then, if we do have a good government and a good coalition in place, I think there is some further room.
Well, just to talk about that point a bit more, the Indian market is up, almost 10% plus year to date, including currency gains. It is one of the best performing markets across world indices. What is the conviction driving this interest? Is it the new government or the turn in the economic cycle?
I would say it is a combination of both. First of all, I have already mentioned that a lot of positive expectations regarding the election has already been priced in. So the market is expecting a BJP-led majority and a new government which is pro-business and pro-reforms. On the other hand, we have also seen some improvement in the economic activity. So we have seen PMI stabilizing, we have seen current account deficit coming down, and the currency has been stable as well. So in that sense, we have had increased interest in the Indian equity market, as investors perceived it to be less risky.
Since we're talking about India, how can we not talk about elections? What scenario do you think is being priced in by the Indian market in this rally that we've seen over the last 6 to 7 weeks? Many believe that post-elections there will be a sell-on news correction in the market that will mark another buying opportunity. What is your view on what the Indian market does over the next 2 months?
A lot of optimism has indeed been priced into the Indian market. Looking at the latest polls over the weekend, we can see the trend that BJP seems to be the clear winner out of the election. So we will have an NDA coalition, which should be positive for the market because they are considered to be business friendly and also reform friendly. Having said that, as I mentioned earlier, a lot of the optimism has been priced in. So after the election, we will have a time where investors take stock and look at what reform agenda the government has and also the speed of implementation. The speed of implementation is going to be key. And I think that because the investors expect so much from the new government, there will certainly be times where there's going to be some profit taking, which is going to give good entry points for investors.
Right, there is some concern as far as CPI or food inflation goes among emerging markets. Do you think as a variable that's a growing risk for EMs, according to you?
Food inflation is something we always watch closely in emerging markets. The concerns this year are regarding weather-related effects, namely El Niño. So in India, for example, we already had some bad weather, which has affected the food prices. And also it is expected that there will be some effects from the El Niño on the monsoon. So this might push food prices higher. In countries like India, food prices are 50% of the CPI basket. So any increase in the food prices is directly translated 50% into the overall CPI. We have the same concerns in Brazil, for example, where we're watching inflation closely.
Right, then what would this mean for growth as rates stay high and investment is yet to pick up? How much growth do you expect from India?
I think the growth in India will be gradual. For this year, I'd say probably around 5%, from up slightly from last year, around 4.8%. So there is some growth, but a gradual pickup. And one of the reasons for that is that we have had very weak investor sentiment. So the corporate spending has been very low. And looking at the relatively high interest rates and no change in interest rates, I think it is going to take some time to turn around.
All right, let's step back and get your emerging market view then, Dilek. What are the top 3 risks that you would attribute to emerging markets, top of the mind really right now across EMs?
The key risks to EM are, first of all, the impact of the tapering, so a rise in the US yields, and this has been discussed since last May, but it is still present. Also, we have an election year in emerging markets this year, so we have elections around the world. We just had some local elections in Istanbul, but then we have some presidential elections. As you know, we have the elections in India in the next few weeks. We have elections in Brazil. We have elections in Malaysia. So all this political uncertainty is unsettling the market somehow, but it's also a great opportunity for the long-term investor. The other risk in emerging markets is also is slowing down China. So what is China going to do? What are the reforms going to be in China, and how are they going to impact on the material prices, but also on the overall sentiment in emerging markets?
Right, the debate on China continues. How are you seeing the story? Do you believe that China is a risk really right now, or is it an opportunity?
There's clearly some uncertainty surrounding China at the moment, especially regarding the economic growth, while the government is rebalancing the economy from a fixed asset investment-led to a consumer growth-led economy. But having said that, this also brings opportunities for the long-term investors. Where we see the most opportunities are especially in the environmental sector. So the government has to fight pollution, they have to do something, they have to implement the reforms to push through those, so we can find very good companies benefiting from that. We think that in the consumer space, a lot of the pessimism has already been priced in, so we have been selectively picking up consumer names as well into the portfolio. And we think that the IT-related names, so the e-commerce related names, still offer a good long-term investment opportunity.
But when you step back, how does India stack up compared to other emerging markets? Has the India weightage gone up from the start of the year till now versus other EMs from the average 6% that it holds in global EM portfolios, marking it against the MSCI EM index?
For our portfolios, I can say that we're clearly overweight India. We have been overweight since the beginning of the year, and we have been increasing our weight gradually. Now, the reasons I've already mentioned. So there's some improvement in the economy. There's also the currency which has stabilized. And also we expect election outcome to be favorable. Having said that, for a stock picker, India is actually a very, very good market to find good quality companies. So when I compare Indian companies across emerging markets, I can say that the corporate governance is superior. We have very good companies, very well managed, high return on equity, managed in the interest of the shareholders, etc. So that always makes us very positive on India.
Also, what about the EM versus DM trade? Many expected that that would reverse in the second half of calendar year 2014. There are signs that money is coming back into emerging markets. Do you expect that to change in some way? Do you think the money will still be incrementally allocated to developed markets, or given the recent rally, that perhaps the EMs could be in for a turnaround in the second half of this year?
If you look at the performance EM versus DM, emerging markets have been underperforming developed markets for over 3 years now. Looking at the valuations, they are certainly cheaper, but they're nowhere near the trough levels which we had seen in previous crisis times. So while I think there is some short-term bounce, I still need to see a fundamental positive change in emerging market underlying economies. The underperformance of emerging markets went also hand in hand with downgrades to earnings. So we need to see company earnings stabilize. We need to see governments' actions towards potential outflows through the Fed tapering. And we will also have to see a further recovery in the developed world so that emerging market countries can export more.
Right, then broadly speaking, which are the markets that you like as also dislike among emerging markets right now?
The markets we are currently positive on are, first of all, the ones which benefit from an increased trend or trade with developed world. So export-oriented countries, export-oriented companies, and India is one of them, especially in their pharma and IT sectors. We find very good companies with solid growth potential, which has already been a trend for the last few years. We also like Mexico in the long term. Mexico has implemented some energy reforms which have been long awaited. The impact we're not going to see immediately. I think the impact will take at least another year to show in the economy, but for the long term it's very, very positive. In the emerging European region, we are currently looking at Greece, for example, which we think is through the worst, and from here it should start improving again.
Dilek, how has the fund flow trend been like between ETFs and long-only funds? Where is money being incrementally allocated?
It is difficult to give you a direct answer for this since we can't track all the mutual fund flows. I would say that the first money has started going into ETFs, and in terms of the mutual funds, we will start seeing some inflows following. But obviously there are also institutional accounts, and I can say from our experience that the institutional investors have actually not massively decreased their allocation to emerging markets.
Also within emerging markets, where is interest strongest? EM dedicated funds have seen outflows. Has that reversed or abated somewhat? BRIC funds, are they drawing a lot of the money? India dedicated funds, India ETFs, etc. Out of all these products, where is the most amount of interest coming in, especially over the last month or so?
If we look at the flow data year to date, across emerging markets, we're still in negative territory. So as you said, outflows. In fact, the first 3 months in this year, we've seen more outflows than the whole 2013 together. BRIC funds, similar story. Why? We had outflows from Russia, especially after the Crimea crisis. But India stands out. So India has seen inflows, whereas most of the other markets have seen outflows. Other inflows are into the smaller Asian markets. So Indonesia had strong inflows year to date as well. But we still continue to see outflows out of the larger markets. So China, we've been seeing outflows. Russia, I already mentioned. But even Korea, we have seen some outflows.
All right, let's talk about your sector preferences and your sector overview essentially. Which are your preferred sectors in emerging markets right now, consumers or cyclicals?
You have to always treat this question with caution, because at the end of the day, we're long-term investors, and what we like in stocks is we're looking for long-term sustainable earnings. We look for stability and in cash flows. We look for stable balance sheets, and also we look at solid market positioning and pricing power. And this is why in the past we have preferred consumer companies over cyclicals. But having said that, we have increased our allocation to cyclicals recently, but we are still not overweight. So we have reduced our underweight, but again, within the cyclicals, we have been picking the higher quality names.
Also, Dilek, how do you see the potential of EM exports? In India, IT and pharma exports have done quite well. Is a dip, correction, an opportunity to buy? I mean, of late, last 6 weeks or so, we've seen some of these stocks correct due to interest in cyclicals rising.
Certainly, because I think that this is a trend which is ongoing. Indian IT and pharma companies are actually gaining market share globally, especially in the US as well. So look at the generics industry, also look at the branded sector within the pharma. Indian markets are constantly gaining market share there. On the IT side, again, since the crisis, Indian IT companies have been gaining market share. So I think IT and pharma should be a core holding in any Indian portfolio.
Also, are you viewing India as a large cap story essentially, or are you looking at evaluating and buying into some of the broader market names, some of the mid cap and small cap companies as well?
We have some restrictions, but that is more liquidity related. So in that sense, we can't really invest in the truly small caps, but we do have some mid-cap exposure. And within this exposure, obviously, we will have to limit our position sizing and constantly cut back and take profits. But we like companies where we think there is a potential for them to become a large cap in the next 2-3 years. We are long-term investors, hence we don't shy away to build up positions even in names which are less liquid. But we have to monitor them closely, and we work very closely with the managements to make sure that we're on top of their earnings, margin expansion, and also their market positioning.
Right, Dilek, now in your declared portfolio, you have Infosys and HDFC. What's the rationale for your conviction in Infosys, given the revenue warning issued by the company and the fact that the stock has underperformed peers such as HCL Tech, TCS, Tech Mahindra?
The reason why Infosys underperformed over the long term is actually that they got their strategy wrong after the financial crisis. And we have met the CFO recently, and we've gone through their plan, how they want to change the business, how they want to cut their costs, how they want to restructure the sales focus, and also bring up the productivity of their employees. So for us, Infosys is rather a restructuring story. And the question as an investor is, do you believe what the top management is trying to achieve or not? I think the cost savings can be seen rather sooner, but it will take time for the other changes to be appreciated by the market. And especially senior level or mid-level management departures, etc., are unsettling the market. But we think that the management is doing the right things to bring Infosys back to being market leader.
Now, the RBI, of late just issued new banking licenses. The license went to IDFC, not to L&T Finance or Bajaj Finance. Are the non-bank finance companies an area that you like? Do you see potential there?
You cannot really generalize in that sense. What we're looking for is that we want companies which have high return on investment. We want companies which are well positioned. So this is why, for example, we have HDFC in the portfolio. Now, concerning the other bank licenses, I would caution there, because what they're trying to do is what ICICI, for example, did 20 years ago. So they're trying to become a fully fledged bank. Now, over the last few years, the banking environment has changed significantly. You have stricter regulations, you have increased competition, and you have strict capital requirements. So for any new company to start setting up their banking operations, it's going to be very cost intensive, especially also trying to build out your branch network. So in that sense, I would rather wait and see how they execute.
As also, what's your view on energy? There is much focus on state-run exploration company like ONGC, and especially state-run oil distribution companies, oil marketing companies, BPCL, IOC, etc. Have you looked at this sector?
We have looked at the sector, but overall for the portfolio, we prefer to stay away from companies, also from sectors where there's too much government intervention.
Okay, talking about specifics then, what have you been buying in the last 3 months in India? More of your existing holdings, something that we just talked about, or names in autos, infrastructure, cap goods, power companies, some of the high-quality cyclical names?
What we've done in India is we have increased the cyclicality of the portfolio. So we added to some banks, but private banks. We've also added in the capital goods sector. But we still hold on to our core positions in IT and also in healthcare. And what we would look to do is add rather to the latter sectors after the elections.
Dilek, thanks very much for joining us and giving us your perspective on the markets. I really appreciate your time today. With that, we come to the end of this edition of India Decides, the FII View. We leave you with a slice of political opinion on the markets from Alison Newton of Namira.
It's clearly not helpful in the run-up to an election when you see open divisions within the hierarchy of any party. In almost any democracy, personalities become perhaps almost as important as policies in an election. We put a 75% probability on the NDA, BJP's coalition, winning more than 200 seats. We don't know how, to what extent we're going to see a late rally behind Congress and its associated parties. It could happen. Competition is fierce in Indian elections. Women are becoming increasingly important in Indian politics, as indeed they are in politics in many other countries. And a better gender balance in terms of representative assemblies in India can, in my view, only be a good thing.